Mansa-X, a product of Standard Investment Bank, made a return of 4.13% for the second quarter of 2022. This compares to around 2.6% during the same quarter last year and 3.8% for the first quarter of this year. A better performance was seen in this year's second quarter, mostly because there's less market action because most traders have gone on for their summer holidays. There's less liquidity in markets, so there tends to be less volatility, or rather just less action. So this year, because of what we are seeing happening in Europe, the geopolitical tensions caused by the invasion of Ukraine by Russia, we saw a lot more volatility, especially in the commodities markets, and the impact of this on inflationary numbers. And the other thing that caused more volatility was now the reaction of central banks around the world to the inflationary pressures created by those geopolitical tensions, as well as supply chain constraints around the world that continue to impact on delivery of important commodities to various ports. So this Q2 was very different from most other Q2s. There was a lot more excitement in markets, a lot more nervousness around what the correct pricing of various financial instruments would be. And this created a more volatile environment that we were able to take advantage of to create a better return in Mansa-X, which is what we always say, that our fund is able to leverage on various asset classes to squeeze out a higher return than a normal fund would typically be able to do. Our best performing assets in Q2 2022 came from commodity assets at the equities market, specifically mostly US markets and specifically technology stocks. We also saw a lot of action in the yield plays and FX derivatives. So just back on commodities, our main and biggest movers were wheat, moving over 40%. Natural gas almost doubled its price at some point. Oil prices hit an all-time high as well, from $75 a barrel to as high as $125 a barrel. We also saw significant volatility in corn and sugar prices. It was also interesting to watch the coffee market as well. For technology stocks, we were mostly short. As we had mentioned in Q1, we expected that in Q2, due to the increase in the increase in the Fed rate, we expected that a lot of these stocks would take a beating. So we were short stocks like Shopify, Roku, Block, PayPal, and many other technology stocks, and this gave us a significant return. We were also largely long the US dollar. Therefore, we were looking to, and we were short the euro. We were very long the Japanese yen. Most of these currencies are actually trading at their 20-year lows against the dollar. That's because we have seen a significant dollar increase dollar strength during this period, and we expect this to continue. For the yield plays, we expected that yields will continue to rise, so we were short the US 10 years and the German bonds. Again, this was a very lucrative play for the fund. Our fund depends on volatility to make a return. So we don't necessarily make returns when prices go up. We also make returns when prices go down. We just need significant movements on either side. So Q2, due to the geopolitical tensions between Russia and Ukraine, and also inflationary pressures globally, because right now you're looking at the highest inflation levels you have seen in decades. For example, the US right now, inflation is at 8.6%, highest levels in over 40 years. The UK as well, 9.1% on inflation. The Eurozone inflation at 8.6%, back closer to home, 8% inflation as well. So globally, the inflation levels are significantly high at 8%. So central bank actions, of course, are frantic and nervous, trying to figure out how to contain this inflation. And at a very interesting time when you're also talking about concerns of a recession. Because if you look at the Q1 GDP growth, for example, in the US, the US GDP growth contracted by 1.6% in Q1. It takes just another quarter of contraction for you to go into an official recession. But you can see why this is contradictory. So you have the chances of you going into a recession, and at the same time, your inflation is high at 8.6%. So typically, central banks will have to increase interest rates to manage inflation, but they would still need to reduce interest rates to stop recessions. So it's a very difficult time for central banks to figure out how to balance the two. So traders such as ourselves, we're watching central bank actions very closely to know how to trade these asset classes. The first obvious trade was mostly really just shorting overvalued tech stocks. This is why we were short most tech stocks whose valuation had largely been boosted by central bank actions in the last 2 years as they managed the pandemic by pumping trillions of dollars into the economy. So a lot of these tech stocks benefited from that liquidity. Reduction of that liquidity, like we saw in Q2 when the Fed increased their interest rates by 75 basis points, of course, removed that liquidity from the markets, and that reduces the valuation for most of these stocks. So we largely benefited from the stocks I earlier mentioned by shorting them in the markets. Commodity plays were a big deal for us. What happened between Russia and Ukraine continues to put significant pressure on commodity prices like wheat, corn, natural gas, oil, and we expect this to continue. Of course, for some of these commodities, towards the end of Q2, for example, in commodities like oil, due to recession fears again, we saw a pullback in some of these valuations. But during Q2, there was significant upward pressure, and we made returns from that. Going back to central bank actions, the other effect is the effect on long-term yields, where we saw significant movements in the long-term yields of, for example, the 10-year treasury is moving from 1.9% to as high as 3.5%. That's unprecedented in the near past, and this helped us as a fund to make significant returns, just shorting the US 10-year market. We were also playing in continental Europe bonds, like the German 10-year bonds, which again also went from as low as 0.5% to almost 2%. Again, those are significant moves for a bond to make, especially long-term bonds of that nature. FX derivatives were also interesting to play during the Q2 period. Dollar strength was quite significant, and if you remember, we mentioned this in the last video where we expected that dollar strength was going to be significant in Q2. We continued to make that play, and we saw, for example, the euro trade at 20-year lows against the dollar. The same thing happened to the Japanese yen, and most other currencies also lost value against the dollar, especially in the frontier and emerging market economies. We expect to continue to see more of this again in Q3. But Q2, to sum it up, was an interesting period of inflationary pressures, geopolitical tensions, and central bank actions around how to deal with those two factors. And then you also had the effect of supply chain constraints that seeped over into the new quarter. I mean, the reasons for this, we already had an issue with the zero COVID tolerance by China from last year that had caused supply chain constraints. Now, just when we were about to heal from that, you then have supply chain constraints caused by the Russia-Ukraine conflict. So again, it became a factor in Q2, again exacerbating the inflationary pressures. So whereas Q2 tends to be a very dull and sleepy quarter, as has mostly been for the last 3 quarters or so, and that has been demonstrated in our performance and most other fund performances, this year's Q2 was a lot more exciting, and that's how we were able to make a higher, better return for our investors. Q3 of 2022 is actually a very interesting quarter for us. A lot of our approach to our trading and how we balance our portfolio will be driven by the outcome of a lot of data from Q2 and the central bank's reactions to this data. So for example, as I mentioned earlier, it's very important to know what the GDP growth numbers for Q2 for the US would be, so that we can compare this with Q1 to know how the Fed then reacts, whether they'll be more aggressive in their Fed rate hikes, or they will be a bit less aggressive, because then this will affect markets. So typically, if you have 2 quarters of negative numbers, you go into a recession. And the question then becomes, do you expect a negative GDP growth number in Q2? Right now, the forecasts are actually for a positive number. We had negative 1.6 in Q1. For Q2, we actually expect positive 1.9. So this might negate that argument. So what does that mean for stock markets? Typically, for the S&P right now, we are trading at mostly all-time lows, especially for most US stocks. So the question becomes whether we expect a V-shaped recovery from this, or simply what you call a bear rally, where you see a bit of a rally before a continuation of the downturn. Or do we expect that the numbers in Q2 will be so bad that then the bear rally, the bear market continues into Q3? So as we've always argued, our fund is designed to take advantage of to take advantage of data and use that data to create a very diversified portfolio for investors. So this will not change in Q3. We will continue to be looking at different data points and to then use this data to decide how we will rebalance the portfolios for our clients. I guess this is the most prudent approach to use for now. And if as the data comes out, of course, we'll continue to inform our clients. But if the numbers for Q2 come out as positive, then the next time you can have a negative, a recessionary outlook would then be in 2023. We still expect that you might end up with a recession, but maybe in 2023. So how to play between now and the end of the year becomes the biggest question. For us here at Mansa-X, we are still very confident that most of the positions we've taken will continue to be to give a positive return in Q3, including the easier ones. For example, being long softs, especially agricultural softs. For other commodities like oil, now we are a bit more cautious, because if you do end up in some sort of recession, then oil prices will sort of subside. But then again, our fund could still make money even if oil prices retreat, because then we take short positions in oil prices. We are yet to see how that plays out. We'll also be looking at dollar strength. We do not think that dollar strength is going to subside, mostly because even in other economies like the Eurozone and the UK, they're also struggling with their own recessionary fears. So we expect that the dollar will continue to be strong even in Q3. That's one of our more sure bets. In fact, there are talks of the euro reaching parity against the dollar. It will be interesting to see whether this actually happens within this quarter. But that's one of the biggest plays for Q3. Locally, we believe that local stocks will continue to rebound. We saw in Q2 a significant loss of value of most local stocks, even our biggest holdings locally like Safaricom. We feel that some of these stocks were mostly affected by the global risk of attitude. So you had a lot of loss of liquidity in local markets because foreign investors were removing their liquidity from local markets, not because local markets were doing any worse or because of what is mostly cited as a reason for local markets dropping, which is elections. We don't think that's actually the reason. It's mostly because rebalancing of portfolios during risk-off periods requires global fund managers to reduce their holdings in frontier markets. Kenya happens to be one of the ones that are affected by this. It's a contagion effect. So as rebalancing of portfolios happens, we expect the local stock markets will actually regain some of their value. And we're already seeing that. Just the last 1 week alone, we've seen a rebound in telco and banking stocks, and we expect this to continue. On the yield side, we'll continue to expect higher yields in markets, in most fixed income markets, and we'll continue therefore to be short fixed income markets in the US and continental Europe. Moving forward, we are still very positive that the fund will continue to deliver higher than average returns because of the diversification that we actually employ within the fund, the ability for us to be in so many asset classes, and to also have the ability to be long or short these asset classes. We've always said that this is the reason why we're able to give a higher return, and it has been continuously proven quarter on quarter, and we believe that there's no reason for this to change. Two of the major questions that a lot of our investors are asking our financial advisors is, how is Mansa-X going to perform in Q3 and for the rest of the year, considering that we have elections coming up and there's this talk of recession all the time, and our investors are legitimately concerned about whether this is going to affect how their portfolios perform. So on the question of elections, when we look at historical data, there's very little to suggest that the local stock market actually underperforms because of elections. It's mostly something to do with rebalancing of portfolios globally. So like recently we saw the stock market lose value because there was a risk-off attitude globally, where global fund managers were reducing what you call risk on assets. Investing in a frontier market like ours is considered a risky investment. So of course they will pull out their funds if they're trying to rebalance their portfolios, and that affects our local market, mostly because our local market is almost 70% foreign investors. So moving forward, we are already seeing it in the last 1 week or so. We have actually seen a return of much of that liquidity. So we expect that the local stock market is going to rebound. Again, looking at the valuations of most local stocks, our average price earnings multiple for the market is about seven times price of the stock versus how much the company earns. At some point, we were trading at 4 times price versus earnings multiple. That shows you that a lot of our stocks were actually undervalued and continue to be undervalued. So we still believe that the local stock market, from a performance perspective, is still undervalued and is a good investment to make, especially for our telcos like Safaricom and our banking stocks like Equity and KCB. So we will still hold that view. Back to elections and the performance of Mansa-X, the fact that a lot of our investments are actually in global financial instruments means we are not exposed to the local market. In fact, it's the other way around. We don't even necessarily notice it because our asset classes are spread out from commodities to metals, global stocks. At any one point, we hold up to 50 individual equity stocks spread out around the world. So we are not necessarily exposed to the local market. And this makes Mansa-X a fantastic avenue for anybody who wants to diversify from the happenings of the local market. If you are trying to ask yourself, how do I hold my money right now in a place where the outcome of the elections in August do not affect me, Mansa-X is a perfect answer for you. That's where you should be putting your money. So the other question that investors have for us is, are we going into a recession? That was a legitimate concern and continues to be a legitimate concern this year. If you look at Q1, US GDP numbers contracted by 1.6%. We need a second negative number in Q2 for us to go into a recession. But recently, analysts are projecting that we'll actually have a positive number. If that happens, then we are officially not in a recession. But concerns now become around GDP growth for Q3 and Q4, especially because the argument for Q2 being a positive number is because the base comparison with last year is a pretty low one. So maybe that's why we had a positive number. So if we get a contraction in Q3 and Q4, then we are in a recession in 2023. So conversations around a recession seem most likely to be biased towards 2023. How do we prepare for this as a fund? Does this affect the performance of the fund? Because a lot of our investors are still wondering whether Mansa-X is able to make a return when everything is falling. When the house of cards starts crashing down, does Mansa-X still deliver a return? I want to assure and give confidence to our investors that this fund is exactly designed for this sort of thing. In fact, we may likely be able to squeeze out a higher return during a recession than any other time, because sometimes markets tend to rise slowly, but when they fall, they tend to fall very rapidly. And we are able to go short a lot of asset classes that would typically be affected during a recession. And this again was demonstrated in Q2 to a small extent around the technology stocks. Now you can imagine this happening in the whole market, and how much more we are then able to make for our investors, and not only to make returns for them, but also to protect them from their other portfolios. So, for example, if you're an investor who has invested in, say, real estate, or you're an investor who has invested in the local stock market, or any other asset classes, and you want to protect yourself by having a portfolio that will make you a return if things turn negative, then again Mansa-X becomes the obvious choice for you, because we are here to protect and make money for you even when markets are retreating. So to answer your question, as investors, we cannot confidently say whether we are in a recession right now or whether this is going to happen in the next half of the year. There's a possibility we might go into a recession in 2023, but Mansa-X will make a return whether this happens or not, or rather it is designed to make a return whether this happens or not. And that is where our confidence comes in, based on the ability to go long and short and to diversify the portfolio to take advantage of the various asset classes and how they perform during normal markets or during recessions. Just to conclude, we'd like to thank our investors, first of all, for believing in us. This quarter alone, we've grown from managing 7.9 billion to now managing 9.3 billion. That shows that our investors believe in us. The reason I say this is because most of the growth is actually from top-ups from our own clients, and then we have had new clients who have believed in us and brought in their funds. We hope we continue to give you a better return than average, because that's what we seek to do. So one of the things we try to do is give you a better return than average. The second thing is to give you access to your funds when you need your funds by investing in liquid assets. Now, the combination of the two is definitely a very difficult thing to combine. Just to explain, typically when you get a higher return, you then compromise on liquidity, and vice versa. If you have very easy liquidity, then your returns also tend to be much lower. So for Mansa-X, we had to look for a sweet spot where we are able to give you just the right balance of those two things. And we're very happy that we have proven the model to be able to deliver this for investors. We thank you very much for that. And just to assure our clients, like I mentioned earlier, whether it's elections, whether it's a recession globally or not, we will still be able to give you a better return, mostly because our fund is able to really diversify where we place your funds, and we are able to get returns from very many areas that would typically not be available to a fund manager who only has a few asset classes to invest in and only one way of trading those few asset classes. And this is important because there's always this perception that does Mansa-X make a higher return because it's taking on more risk. And in a sense, that is an argument that needs to be checked, because you can actually make a slightly higher return than other fund managers without taking on the disproportionate risk, or without creating disproportionate risk. And I believe that's what Mansa-X has been able to do, and this is what we continue to make as a promise for our investors. We thank you very much for your belief in us. We hope that you can top up more. We know that a lot of our investors have investments elsewhere, and Mansa-X is part of their portfolio. But we believe, especially moving into more volatile periods, we believe that you should invest more of your funds with us in Mansa-X, because we are able to play out a volatile market better than most other funds might be able to do because of certain restrictions. And we are looking forward to a stronger Q3 and to serving you better. Thank you.